The Global Allocation Fund is a very, very diverse global portfolio, and it invests across a wide variety of global equities, global bonds, and cash equivalents. And what we're trying to do with that very, very broad reach across asset classes is give investors a return that's very competitive with equities over a full market cycle, but with substantially less risk. In Australia, we started the fund back in 2005, in July 2005. And what we've seen over that time is very, very strong performance over the last, it's been here for 8 years. It's delivered around 88% return. And when you think of the sorts of environments in terms of markets that we've seen since 2005, with initially quite a strong bull market, and then what everyone's affectionately referring to as the crisis of 2008, where we saw equity values and a lot of fixed income values plunge across the field. To have nearly doubled your money over that time frame is an outstanding achievement, and we've been able to do that with significantly less volatility than, say, a pure equity-only investment. The global allocation strategy has been running in the United States since 1989, so we've nearly got 25 years worth of track record, and it's just history repeating. It's been delivering very, very competitive returns with very, very low levels of volatility when compared with a fully invested equity fund. The process of the Global Allocation Fund is they are scouring the world for what they see as the best risk-return trade-offs to invest their clients' money. And what's very important is when they come to investing their clients' money, they want to get an equity-like return over the market cycle, but they also want to be very protective of capital. They don't have the opinion that the biggest risk a client has is they underperform any given benchmark. The biggest risk that a client has is that they wake up one day and they don't have any money left, whether that is because equity markets have fallen substantially and they've lost a significant amount of their life savings, or because they live too long and haven't had a competitive return to generate the returns that they need to sustain their lifestyle and retirement. So when it comes to looking the world for opportunity, the way the world looks to the guys at the moment is in terms of where you are going to get compensated for the risk that you take on. We much prefer equities to bonds. There are very, very few places in the world where bonds will compensate you for the risk that you're taking on, as opposed to equities where, although some valuations are starting to look a little bit stretched, there are still some very, very attractive pockets around the world where you can find some excellent investment opportunities. At the other end of all that, of course, is we've got a substantial amount of cash sitting in the portfolio, which is there as both a diversifier in the portfolio and keeps volatility lower. Or certainly lower than a fully invested equity fund, but it also means we've got dry powder when opportunities do arise. If you think about what we're trying to do and get those equity-like returns for a lower level of risk, I don't know too many investors that that's not applicable for. So it's certainly a very, very wide-reaching fund, and it's certainly a fund that is applicable to all types of investors, and it can be used in a myriad of different ways depending on what the client's individual objectives are. At BlackRock, we have a very, very broad range of products, and one of the real beauties, I suppose, of working for a firm like BlackRock is you get to have some really good conversations with advisors around which of our products are suitable for what they're trying to achieve for their clients. We don't have one particular thing that we're trying to ram down people's throats. It really is a consultative approach, and it's what is best for your firm, what's the best for your clients and their investment objectives.